Everyone wants to grow their money, but no one wants to lose it in the process. And 2025, it just feels like a confusing year, right? The market's climbing, inflation's cooling, but this feeling of uncertainty still kind of lingers. So how do you protect your money without just sitting on the sidelines? Welcome back to Invest Education Hub, where we turn smart investing into simple decisions. In today's video, we are going to build a safe, diversified investing strategy that keeps your money growing without all the stress of trying to predict what the market's going to do next. Stay until the end, because I promise this framework could totally redefine how you think about safety, risk, and what real long-term growth actually looks like.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's dive right in. This isn't just a thought for some Wall Street pro. It's a feeling that every single one of us has. You're probably asking yourself this very question every time you even think about checking your portfolio. It's that little knot in your stomach when you see the market go up and you wonder, should I be in more? And it's the exact same feeling when you hear whispers of a downturn and you think, oh man, should I get out? It is the central tension of all investing. And that right there is the fundamental question we're here to answer today. Now look, this isn't about finding some magic bullet or trying to time the market perfectly. That is a fool's errand, trust me. It's about building an intelligent, robust system, a system that can navigate the uncertainty we're all feeling, and most importantly, let you sleep at night. It's about finding that perfect sweet spot between ambition and security. To solve this, we're going to go on a little journey together. First up, we'll diagnose the unique challenges in today's market. Then, we're going to completely rethink what safety even means for an investor. From there, we'll get super practical and actually build a model portfolio piece by piece. After that, we'll dig into the mechanics of why this framework is so powerful. And finally, we'll cover the crucial mental traps that can derail even the best plans. All right, first things first, let's set the stage. If you're feeling a bit confused by the market right now, you are not alone. The word of the year has got to be conflicting. We're getting good news and these scary cautionary tales all at the same time, which makes it incredibly difficult to figure out which way to turn. So here's the push and pull we're all feeling. On one hand, you've got these relatively high interest rates, which are making safe things like high-yield savings accounts look really good for the first time in, over a decade? That's a huge temptation to just play it safe. But at the same time, inflation is down, sure, but it's not out. It's still there, keeping everyone a little on edge. And while the stock market has been climbing, we all know from experience that volatility is always just waiting around the corner, ready to test our nerve. And this whole environment creates this intense psychological battle inside every investor's head. It's like on one shoulder, you've got this little FOMO devil whispering that the S&P 500 is a rocket ship leaving the station without you. It's telling you, go, chase those gains. But then on the other shoulder, you've got the FOLO angel, reminding you of those gut-wrenching drops we've seen in the past, urging you to be careful. And this constant back and forth, it can freeze you do nothing, or even worse, it makes you jump in or out at exactly the wrong time. So here's the crucial point, the big takeaway from all this. We have to redefine what safety means. It isn't about hiding your money under the mattress and just hoping the storm passes. That's just standing still while inflation is slowly eating away at your savings. No, true safety means being prepared to weather the storm, no matter which direction the wind blows. It's about building a financial plan that's resilient by its very design, not by chance. Safety is not avoidance, it's preparedness. All right, so that leads us perfectly into our next section. We're going to see how this idea of preparedness builds into a really powerful principle. We are going to shift our entire perspective. Instead of trying to dodge every single risk, which, let's be honest, is impossible, we're going to build a system that's designed to manage and absorb those risks effectively for the long run. The core idea here is that true safety isn't found in a crystal ball. It's found in a blueprint. We call this risk-controlled investing. And what that really means is instead of guessing what's going to happen next week or next month, we rely on principles that have stood the test of time: smart asset allocation, broad diversification, and the discipline to actually see it through. We just admit we can't predict the future, so we build a portfolio that doesn't need to. Now, to make this idea really concrete, let's use a powerful analogy. I want you to think of your portfolio as a vehicle that's designed for a really long journey, okay? In this vehicle, stocks are your engine. They provide the horsepower for growth. Historically, stocks are the asset class that has delivered the highest returns over the long term, pushing your wealth forward and crushing inflation. you're not going to get very far without a strong engine. But a vehicle with only a gas pedal is basically a death trap, right? You need control, and that's where bonds come in. Bonds are the brakes of your portfolio. When the stock market gets all volatile and starts swerving all over the road, bonds typically provide this amazing stabilizing force. In a lot of downturns, they either hold their value or even go up a little, slowing your portfolio's fall and keeping you on the road. They stop a bumpy ride from becoming a catastrophic crash. And finally, for those sudden, out-of-nowhere jolts, you need a fail-safe. Cash. Cash is your seatbelt. In a severe market crash, cash is your ultimate protection. It holds its value, it gives you instant liquidity for emergencies, and crucially, it prevents you from being forced to sell your stocks or your bonds at the absolute worst possible time. You need all three, the engine, the brakes, and the seatbelt, to travel far and to travel safely. Okay, so we've got our philosophy, we've got our analogy. Now it's time to get practical and turn this whole concept into an actionable plan. This is where we actually build the vehicle. This section is all about a concrete framework that balances our engine, our brakes, and our seatbelt for the long journey ahead. Now, this is where it gets really interesting, because we can see how we translate that car analogy into a tangible plan. Just look at this balance. You see that a total of 60% is our engine. Those are stocks for growth. Then you've got 20% acting as our brakes, that's bonds for stability when things get rocky. Then 10% is our seatbelts, that's cash for immediate safety and liquidity. And that last 10%, the inflation hedge, think of that like having all-weather tires, giving you extra traction when the value of your money starts to slip. And this slide just brilliantly illustrates the big picture. So let's slow down for a second and really break this down. For our core equity, you'll notice it's the biggest slice at 40%. A great example is an S&P 500 fund like FXAIX. This is your foundation, the 500 biggest, most stable companies in the US. But we don't stop there. We broaden that out with a total market fund like FSKAX, which adds thousands of smaller companies into the mix. This gives you true diversification across the entire US economy. Then, for stability, a total bond market fund like FXNAX or BND is our anchor, our brakes. And for that inflation hedge, something like a real estate ETF like VNQ can be great, since property values often rise with inflation. Historically, a mix just like this has shown incredible resilience. During the 2008 crisis, for example, while the equity engine just completely stalled, the bond portion acted as a powerful brake, cushioning the fall far, far better than an all-stock portfolio ever could. Now, it is absolutely 100% critical to understand this. This portfolio is not a prediction that these specific assets are going to be the best performers in 2025. Not at all. It's a strategic framework. It's designed to be durable, to perform reasonably well in all sorts of economic conditions, whether we see high growth, a recession, or that stubborn inflation. The goal isn't to be perfect. The goal is to be prepared and resilient always. So the big question is, why is a disciplined framework like this so darn effective over the long haul? I mean, it doesn't have the glamour of trying to pick the next hot stock, but its real power lies in its structure and the time-tested principles it's built on. So let's explore the mechanics that make this approach a quiet winner over decades. The benefits really come down to a few key principles. Diversification is called the only free lunch in investing for a reason, but that second point on the list, rebalancing, that's the secret sauce. Here's what it is. Once a year, you just adjust your portfolio back to its original targets. This forces you to sell a little bit of what's done well and buy more of what's lagged behind. In other words, it makes you automatically sell high and buy low, without letting your emotions get in the way. And then, of course, there's the most powerful force of all, compounding. The power of compounding, even with seemingly modest returns, is just staggering. A balanced portfolio like this one isn't aiming for those flashy 20% returns. No, it aims for consistency. So, for example, let's just look at a conservative hypothetical growth rate of just 6% per year on average. It doesn't sound like much, does it? But here is where it gets absolutely incredible. This is the rule of 72 in action. At 6%, your money doubles roughly every 12 years. So an initial investment of, say, $10,000 becomes $20,000 in 12 years. But in the next 12 years, it doesn't just add another $10,000. It doubles again to $40,000, and then it doubles to $80,000. That is the unstoppable exponential power of your money making money for you. And this right here demonstrates the entire goal. You are not trying to beat the market every single year. That's just a recipe for taking on way too much risk. The true objective is to build a portfolio that you can stick with, one that lets you stay invested through thick and thin for decades. Because time in the market is infinitely more powerful than trying to time the market. Staying in the game is how you ultimately win.
Now, even the most perfectly designed vehicle can be undone by a bad driver. The single biggest risk to your long-term returns is often, well, it's the person you see in the mirror. So let's cover the critical behavioral mistakes you need to sidestep to make sure your plan actually succeeds.
Think of these as the 4 horsemen of portfolio destruction. First up, panic selling. The market drops 15%, fear completely takes over, and you sell everything. This turns a temporary paper loss into a permanent, very real one. Second, just neglecting to rebalance. Your stocks do well, and pretty soon your 60% engine becomes 80% of your portfolio, making it way, way riskier than you ever intended. Third, chasing rallies. Oh man, that is pure FOMO, and it's a recipe for buying high just before a fall. And finally, being too conservative. Letting too much cash just sit there for too long is a guaranteed way to lose purchasing power to that silent wealth killer, inflation. Ultimately, everything we've talked about comes down to this one simple idea. The mathematically perfect portfolio is totally useless if you just abandon it at the first sign of trouble. A slightly less optimal portfolio that you can actually stick with through a crisis is infinitely better. Your behavior is more important than your allocation. And this brings us to the final and most crucial takeaway. True safety in investing isn't found in some market prediction or a hot stock tip. It is built in your own habits and in your mindset. You have zero control over what the stock market does tomorrow, but you have absolute control over your savings rate, your asset allocation, your rebalancing schedule, and most importantly, your own emotional reactions. That is where real, lasting financial security is forged. Building wealth isn't about taking wild risks, it's about protecting your downside while letting your upside grow. If this video helped you see how to invest smarter in 2025, hit the like button, subscribe, and turn on the notification bell so you never miss new lessons about fidelity, ETFs, and long-term investing. And if you're ready to learn more about building wealth safely, check out our video on You're Not Saving, You're Just Delaying Wealth. It'll show you how to move from saving to truly investing. Thanks for watching, and I'll see you in the next one, here on Invest Education Hub, where we turn learning into lasting wealth.